Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Terry White. Terry is the president and CEO of Sunwest Trust, a self-directed IRA custodian, and the president and CEO of the escrow company, Sunwest Escrow. He's been involved with real estate and investing for over 35 years. So Terry, welcome to the show.
Hey, Juan. Thank you. Thank you for having me.
Hey, it's a pleasure to have you on. I want to say thank you for your time, and let's go ahead and get this party started. So tell us about your background. Tell us who you are. Who is Terry White?
Well, I actually come from an entrepreneurial family. My dad was a builder most of my life. All except 5 years of my life, my dad was self-employed, and my mom worked with him. So I came by this by being self-employed naturally. I have a degree in accounting from the University of New Mexico. And just after I graduated there, I worked as controller for a title company here for about 4 years. And then in 1987, I started my first business, which has now evolved into Sunwest Escrow and Sunwest Trust. And I own an accounting firm, and we're starting a sand volleyball company, and we're doing all kinds of things. So
awesome.
I love business.
Yeah, it sounds like it for sure. Okay. Well, you're my kind of guy then. Okay. So, you obviously focus on, part of one of your businesses is a focus on IRAs. And so that is something that we want to discuss here today. What is an IRA and all the good stuff that goes along with it. And so let's go ahead and, start with that question. What is a retirement account? What is an IRA specifically?
Okay. Well, IRA stands for Individual Retirement Account, and they were created by Congress in 1974. Mm-hmm. So they've been around forever. And the one thing that most people don't really understand is every individual retirement account is self-directed. They tend to refer to the kind of business I do as self-directed, but in fact, the individual that owns that account decides what stocks they invest in, what mutual funds they invest in, those kinds of things. Okay. What my company, Sunwest Trust, does is we then allow you to invest your individual retirement account in the non-traditional type assets. So, if you're going to buy stocks, bonds, mutual funds, you can go to any brokerage house, you can go to any bank and do that. But if you want to buy, in your case, say a small real estate syndication, a small limited partnership investment in real estate or something, the normal brokerage houses and banks won't allow you to do that. So you have to find a custodian such as myself that will allow you to do that, because the IRS requires that you have a custodian actually hold the account. Mm-hmm. Did that make sense?
That makes 100%. Yes. So you have to have a custodian. You can't necessarily do your own, you can't be your own custodian is basically what you're saying, right? You have to have a Correct. Third party, somebody else managing your funds. That I guess the IRS knows that you don't have direct access to your own funds, right?
I'm not sure what the reason is, but I'm glad that they required that, because I wouldn't be in business if they hadn't. But so in order to be a custodian, you have to have a custodian actually hold title to the assets. Right. So that's what we do. And in order to be a custodian, there's 3 ways, I think, to be a custodian. Number 1 is to be just approved by the IRS, which I don't know of any company that is. There may be some out there. The other one is to be a bank. And the third one is to be a trust company. And so that's what we are. We're a New Mexico licensed trust company.
Gotcha. Okay. So before we get into any other details, this is one of the questions that I wanted to ask you, and I guess I should have asked you at the very beginning, but how much equity or how much capital, how much money is out there in retirement accounts? Do you have the answer? Do you have a general idea?
Yeah, I'm a member of an organization called RITA, which is the Retirement Industry Trust Association, and there's probably, 13 to 15 custodians are members of that. And we were in D.C. last year, and we were told at that time that there is now $9 trillion in retirement accounts. So that includes 401ks and IRAs, but it's a huge number. And the exciting thing for me in my business, and you guys in your business probably, is that less than 5% of that is in self-directed accounts. So if there are good investments out there for people to make, there's a huge amount of money out there that can be put in those investments.
Yeah, no, it definitely does sound like that. It sounds like there's no shortage of funds out there for sure. So, the way I wanted to I guess, address our, conversation and our interview is, there's some questions that I have, for those of you out there that are looking to put your funds to work, as a limited partner in deals. But also, I wanted to direct some questions towards those guys out there that are looking to raise funds, and those funds, obviously being through people that are going to be using their IRAs to invest through. So I guess the way we're going to do this is we will be asking questions. The first part will be covering, investing directly, with your IRA as a limited partner. So now that you told me how much cash is out there, which is obviously a lot. Let's say somebody is out there, they have an old 401k account from an old employer, and they wanted to roll that over into an IRA account or something like that. So what would you see the process being like, and how long does it take?
It's a fairly simple process. I think one of the key things you said, and your listeners may already understand how this works, but if you have a 401k at an existing employer, then the opportunity to roll over into an IRA may not exist. There's some different things you need to look into. But your assumption was it's a 401k from a previous employer.
Yes. Mm-hmm.
And so that's what we see happen all the time. And what you do then is you find a custodian that will allow you to invest in what you want to invest in. So let's say Sunwest Trust, because you're going to invest in some kind of a syndication or something. You would set up an account, which is, basically there's forms to do that on our website or on any custodian you choose's website. And you set up your account. That typically takes, 24 to 48 hours. And then the process of moving the money from the existing 401k plan administrator to the new IRA custodian could take, as much as a week or so. It just kind of depends on how fast the existing 401k plan administrator will move and, send the money to the new custodian. But once that money's moved there, then it's a very simple process to make the investment. Depending on what you're investing in, the custodian will require what we call a direction of investment. So that's just a form that says, hey, I want to invest $50,000 in this real estate project. And depending on how they're going to invest in it, whether it's an actual limited partnership or it's an LLC or, a tenant in common interest, I don't know what kinds of things you look at. The custodian will want to see the documentation, and then they'll want to see the actual proof of ownership. So the IRA account holder will tell us to invest X number of dollars, and then we'll say, okay, great, give us the documentation. And the actual title to that asset ultimately will be Sunwest Trust as custodian for Terry White's IRA. And that's the way we'll hold title. And so the profits that are arrived from that investment go back into the IRA. And depending upon what kind of IRA you have, it's either going to be tax deferred or potentially tax free if you're using a Roth IRA.
Got it. Okay. So the process is fairly simple. It's just identifying who you want to use as the custodian. And then, assuming that you're not with that current employer either, right? So we do have to clarify that. It's just an old 401k that you have sitting there that's not doing anything for you. It's not working hard for you. And then the process shouldn't take more than a week? A week?
Yeah, I would say 2 weeks at the most, but usually about a week it should take. Setting up the accounts very quick, and then the thing that takes the longest is actually getting the money moved.
Getting the money moved, yeah. That's what will take the bulk of the time. So, as far as fees, what are the fees that you see involved, not only with the rollover, but also the ongoing expenses, for investing in a project?
Yeah. Well, I would encourage your listeners to get online and really do some research for themselves of the different custodians that are out there. Mm-hmm. So I can speak for all of them a little bit. The majority of custodians out there charge a fee based on either the number and kind of assets you have in your account. They may charge a fee based on the value of the assets in your account. Sunwest is a little unique in that we just charge a flat fee. We charge $275 a year. Doesn't matter if you have $1 million in your account or $10,000. It's $275 a year, and then we charge $10 every time we have to cut a check out of your account. So when we make that initial investment in the LLC or the limited partnership or whatever it is you decide to invest in, so say they say, invest $50,000, we'll cut a check for $50,000 to the investment. We'll cut ourselves a check for $10, and that's it. And then once a year, you'll get a bill from us for the $275 for the annual maintenance on your account.
Yeah, and that's pretty much across the board. Some are actually higher than that. That's actually a very, very favorable numbers that you mentioned. And I've seen some higher than that, so that's good.
Mm-hmm.
Just to give you an idea, for everybody out there listening, it's very doable and very affordable, and it's a solid way to put your money to work. So,
and okay. I would say the thing is, Juan, I would say I would tell people to do their due diligence though, because different custodians, depending on what they're going to invest in, let's say we're talking about things other than real estate syndications or whatever, the fee structures of the different custodians may be more favorable to what an individual is looking to invest in. So, do some research. You know how it is. Everything is available on the internet now. So I would encourage them to do research. Again, my big thing is telling people to research the investment that they're making and make sure they understand what they're investing in and how it's going to pay them back and that kind of stuff. But even before that, research the custodian that you're going to be dealing with and make sure you're comfortable and that you understand what you're getting involved in.
Okay, good points. So at what age can we actually pull our retirement account or a retirement or some of our retirement money out without getting hit with the penalty?
Okay, so the rule is you can't take the money out of your account until you're 59 and a half. And I have no idea why they came up with this half thing, but
yeah.
At 59 and a half, you could start taking money out without any additional penalties. Now, if it's a traditional account, obviously, and you've made non-taxable contributions over the years, then you'll start paying the tax as you pull the money out. The exciting thing for people to think about is using a Roth account, which means that the money that goes into the account is after tax, so you don't get a tax deduction when you make the contribution. But if you wait till you're 59 and a half and you've had the account for over 5 years or had a Roth account for over 5 years, then all of the income that you take out of that is tax-free. So a Roth is a really powerful tool, especially if you're young and you have time to build it up. That all of that income that comes out of it after you turn 59 and a half is going to be tax-free.
Awesome. So that's a good tool to use, for those of you out there listening. Okay. So what are the and plus, going back to the early withdrawal, what's the fee? What's the fee on that if somebody did take it out?
Yeah. If you take it out, it's a little complicated. So if you have deductible or pre-tax contributions to a traditional account, plus you have income in there, and you take that out before you're 59 and a half, you will pay the tax on the money when you take it out, and you'll pay a 10% penalty. So it's not a good thing to do, but it's not the end of the world if for some reason you had to. There are certain exceptions that you can take the money out without the penalty. Those are like disability. You could take a certain amount out for a first-time home buyer, those kinds of things. But generally, you want to wait until you're 59 and a half. The other number to keep in mind, and the other thing I think that's important if you're investing in real estate or investing in non-traditional assets at all, is with a traditional account, when you turn 70 and a half, you have these things called required minimum distributions, which means you have to start taking the money out of a traditional account when you turn 70 and a half. So keep that in mind for any of your listeners that are getting close to that age, because it creates a problem if you have an illiquid asset in your account. So if you have real estate, I love real estate. I invest in a lot of real estate, but it's illiquid. It takes time to sell.
For sure. Mm-hmm.
And sometimes you might have to sell a big piece of property to pay a small RMD. So those people approaching 70 and a half should keep some liquidity in their retirement accounts so that they can take their RMDs like they're supposed to. And there's some very stiff penalties if you don't take your RMDs the way you're supposed to.
Gotcha. Okay, so let's kind of switch gears a little bit and talk about maybe using your own retirement account to buy your own deal. What are the restrictions on that, if any, and who can or who cannot do that?
Okay, so the first thing is the IRS doesn't tell you what you can buy in your IRA. They tell you what you cannot buy. Mm-hmm. And so if anybody, any of your listeners are having a hard time sleeping some night, they can go to the Internal Revenue Code, section 4975, mm-hmm. and read that. And that will tell them basically you cannot invest in life insurance or collectibles. Everything else is available. Okay, so real estate, I mean, we've had people that invest in racehorses. We've had people invest in timber, just whatever you can come up with, we've probably seen. So you can make those investments in that. And there are a few ways when we're talking strictly about real estate, you can buy the real estate directly in the IRA, which means, let's say they're wanting to buy their own house, not their own house, but they're wanting to buy a house for an investment purposes. So you can't buy life insurance or collectibles. That leaves real estate available. Mm-hmm. Then the next thing they have to be careful about is what's called disqualified parties. And a disqualified party, number one, is you're disqualified to your IRA. So what that means is if I own a rental house personally, Terry White owns a rental house, my IRA cannot buy that house from me, okay? But now you and I, Juan, we're not related in any way, so my IRA could buy a piece of real estate from you. The other thing is a disqualified party would be my kids and my parents. So if I bought a piece of real estate from you, I can't rent it to my parents or to my kids because they're disqualified parties to my IRA. So if you're careful with those things, investing your IRA in non-traditional assets is pretty straightforward. And then there's a few ways if you want to get into talking about how you actually make the investment, I'd be happy to discuss that.
Gotcha. Yeah. We're going to go ahead and talk about that. So the key thing that you mentioned is, it can't be like, I guess, linear up and down. It's
ascendants and descendants is the way it's termed.
Yeah, but it can go
interesting to me.
Sideways. Yes.
Well, it's interesting to me because the IRS says your family is a disqualified party, but then they define your family as your ascendants and descendants. So your brother, your cousin, those are not disqualified part. They're not family as far as the IRS is concerned.
Yeah, it doesn't make sense, if you really think about it that way. So,
does anything that they come up with make sense usually?
Not really. You just got to go with the flow.
you got to do what you're told. That's right.
Yeah. So I guess the follow up on that, was, how do you invest, in those, specific type of projects like you were going to say earlier?
Do I invest in them?
No. There's the follow-up.
How do you? I'm sorry.
Yes. Mm-hmm.
Sorry, you kind of cut out there for a second. But okay, so there's basically a couple of ways. Number one is buy the real estate directly in your IRA. And if you do that, if anybody's interested, they can go to our website. We have a checklist there at sunwesttrust.com. And there's a checklist of how you buy real estate. But basically, let's say you wanted to go buy a piece of real estate with your IRA. You go out, Juan, and identify the property that you want to buy. Go out with your realtor, whatever you want to do, look at all the properties, however you do that. And then you find this is the property I want to buy. So then you would create a purchase agreement with the purchaser being Sunwest Trust as custodian for your IRA. And then you would have us sign that purchase agreement and have us, the custodian, issue an earnest money check and present that offer. Okay. If the offer is accepted, then it would go to the title company. The title company would do all the work that they do. And then we would be the actual ones that would issue the final check. Let's make an assumption to make it easy that you're just going to pay cash for this property. Mm-hmm. So then Sunwest Trust would issue the check to the title company to purchase the property. And then the title company would deed the property to Sunwest Trust as custodian for your IRA.
Gotcha. Okay. That makes
and then
sense. Mm-hmm.
as you go along. So then the easiest way to handle this, let's say this was an investment property and you're going to rent it. Well, the absolute easiest way to handle it is to have a property manager who goes out and rents it and collects the rent and pays the utility, pays the bills, whatever has to be done, and then just sends the or the trust company a check for the profits. That's a completely arm's length transaction. That's perfectly fine. Where you need to be careful is, let's say you choose not to have a property manager, and there's some different schools of thought about how much you can do as the owner of the IRA without creating a prohibited transaction. My personal opinion is, I think you could advertise on Craigslist for a renter. You could interview renters. You could, fill out the lease and have them sign it and send the lease and the check to the trust company to have them sign it. But I think it's very clear that you can't go over and change the toilet in the house. You'd have to obviously hire a third party to go do that and have the trust company pay them out of the IRA. So
Gotcha.
It's a little bit, if you're not going to use a property manager, it's a little bit tricky, but it can still be done. It just takes someone who understands what their role can be and what it can't be as the owner of the IRA.
Mm-hmm. So you can't directly benefit from the, your name cannot directly benefit from what the IRA is doing. It has to go
Correct.
back to the IRA.
Both directions. So
Yes.
You cannot directly benefit from what the IRA is doing, and the IRA cannot benefit directly from what you're doing. So that's why you can't go over and remodel the kitchen.
It's got to be somebody else. Yeah. It's got to be somebody else, and then those costs and those expenses have to be paid out directly from your IRA. You cannot pay for it. It has to be your IRA. Yes.
Exactly. Very good.
Gotcha.
Correct. Yeah.
Gotcha. Okay. That is a good thing. So any other restrictions that we haven't covered that you think of?
Not really. It's a fairly straightforward and simple transaction. The thing that happens is we see people all the time just try to get really close to the edge, and it's just not worth the risk. I mean, if you commit a prohibited transaction, you could potentially cause your entire IRA to be disallowed. And so if that happens and you're under 59 and a half, then your entire IRA is going to be distributed to you. You're going to pay tax on it in the year that that the prohibited transaction took place. And if you're under 59 and a half, you're going to pay that 10% penalty. So that's not something you want to do. You want to be careful and make sure that you follow the rules.
For sure. Okay. So a lot of good stuff that you covered, you shared with us on the investing side as far as using your IRA to invest, with. So I want to kind of switch things up a little bit, and let's kind of discuss the general partner side. For those of the guys out there that are looking to raise funds, from folks that have their IRAs, are there any restrictions on the number of deals or number of investments or number of certain capital? Are any kind of restrictions that are out there for that?
Not that I'm aware of. I'm not real active on the investment or money raising side of it. But so if you have someone who is in the syndication business, who knows what they're doing, there's no reason why they can't deal with an IRA pretty much the same way that they deal with an individual investor. The only difference is you've got one little more layer to deal with. They've got to talk to you and convince you to invest. And then if you say, okay, yeah, I'm going to invest, but I want to use my IRA, then you just have to work through the custodian to get the money actually invested and stuff, and then work back through the custodian, to get the money back into the IRA and back to the individual whenever they want that. The number one thing I think to keep in mind that we see a lot of potential problems with on real estate and non-traditional assets in general is, as a custodian, we are required to report to the IRS as of December 31st every year the fair market value of the investment inside the IRA. So that sometimes becomes difficult. I'm in Albuquerque, New Mexico, and if you're buying a piece of property in Kansas City, Kansas, I have no idea what that's worth. So we depend on the IRA account holder every year to tell us what the value of the asset in their account is. And so while the account is active and it's just sitting there, it's not crucial that be an actual appraisal, but it's important that it be a third party evaluation of what the asset is. So those your listeners that are syndicators and stuff, keep in mind what would be really nice for them to do is at the end of every year, if they just got some comps or something on the property that they're dealing with and provided that to their investors or the IRA account holders, then they could provide that to us, and then we would report that to the IRS on what's called a Form 5498 in May of every year. The issue we run into is just trying to figure out what a particular asset within an IRA is worth.
Right. Do you have any idea why the IRS would want to know this value every single year?
Well, I don't know exactly why they want to know every year, because there's no tax consequences or anything. Right. I think, they may want to look at it just to make sure that they're very concerned about people, not paying their taxes. Surprisingly, they kind of want everybody to pay their fair share.
Yeah, and for sure.
They want to keep an eye on it. And in fact, in the last couple of years, they've even added us a box on the 5498. Used to, on the 5498, we would just give them a number as to what the account was worth, what the fair market value of the account was. Now they have another box that we have to give them a number of the value of the assets that are not marketable assets. So in other words, everything that we hold, not everything that we hold is not a marketable asset necessarily. It's not like you can, like the stock market, where I can just, call up the exchange and see what my Apple stock's worth or whatever.
Right.
So we have to report that to them every year. Now, the most important times for the IRS are when there is a taxable event. So for instance, they really want to know what the value, an accurate appraisal on a piece of property in the event the taxpayer is going to convert from a traditional to a Roth account. They're going to have to pay taxes on the money that they move over. So they don't want you to say, oh, this house is only worth $50,000, and you convert it to your Roth at $50,000, and then all of a sudden it's worth $250,000. So they want a real appraisal whenever there's a taxable event taking place, which would be a conversion to a Roth, a distribution to the individual account holder, or when they turn 70 and a half and they have to start those RMDs.
Yeah, so they basically just want to stay on top of what's going on. Basically they want the latest and greatest information, and just so that they won't get the short end of the stick is basically what it sounds like. Yeah. Okay. So this next question may be more for a CPA, and I know you're not a CPA, but this is more of a CPA question. But the reason why I'm asking is because we've had questions like this in the past. And, and these are from people that are investing, through their IRAs, what the tax, implications are on the cash flow of a property. And you can say your limited information that you can say legally on the show, but, there's going to be cash flow throughout the year. And then there's going to be the capital gains, whenever they exit on the property. What are those tax implications throughout the year? Is that something that comes out of directly from the account, or is it something that you pay out of pocket? How does that work?
Well, so real quick, let me just say, first of all, you made the point. I'm not a CPA. I'm not a tax attorney. I'm not giving tax advice, and I'm sure your show's not giving any kind of.
No, we are not giving any kind of advice. We just wanted to educate.
I encourage people to talk to someone, but to give them an idea. First of all, there are people out there that will tell you investing in real estate in your IRA is not a great idea. And the reason they say that is because, as you know, real estate has its own tax advantages.
For sure.
On its own. You lose those tax advantages by investing inside your IRA. So you don't get depreciation. You don't get to deduct the interest that you pay on the property if you have a loan. you're not going to get capital gains. So all of the income that's coming in from a rental property, all of the rental income that's coming in is going back into your IRA, and it's tax deferred or tax free. So it's just sitting there, and it doesn't matter. Let's say you bought this house for $50,000, you rented it for 5 years, you sold it for $350,000. You've now got $500,000 in your IRA. None of that is taxable. Nothing. There's no reporting of any of that you need to do or anything other than your fair market value. We report that every year. Now, where the tax comes in with an IRA is the first time you start taking it out. So let's say you turn 59 and a half and you take out $50,000. That becomes part of your adjusted gross income in the year that you take it out, and you'll pay whatever marginal tax rate that you're in on that money. Okay. So you forget about the idea of capital gains. You forget about the idea of depreciation, recapture of depreciation, all that stuff. None of that applies when you're dealing inside the IRA. It's just basically money in and money out. And then at the time you start taking it out, that's when the IRS wants their share.
Gotcha. So you can just kick the can down the road and defer as much as you can. You're not going to get those immediate tax benefit like right now, but you're also not going to be paying those taxes on capital gains as if you're going to pay or using cash, where you got to pay those capital gains. If you have capital gains inside an IRA, they pretty much stay there, and you're just rolling it until you get to a certain age, where then those taxes kick in. That's when you pull it out, taxes kick in.
Yeah. So let me just, and I've said this before, but I think it's worth saying again. So with a traditional account, you can start taking it out. Well, traditional and a Roth, you could start taking it out at 59 and a half.
Okay.
If it's a traditional account, when you start taking it out at 59 and a half, you start paying income tax on the gains and on the money that you put in pre-tax to begin with. Mm-hmm. If it's a Roth and you're 59 and a half and you've had it more than 5 years, you take that money out with no tax. Okay. Now then jump to 70 and a half. At that point in time, you have to start taking the money out of your traditional account. But the cool thing about the Roth is you never have to take it out of the Roth if you don't want to. So you can leave that to your kids and grandkids and whatever, then they will start having to take that out. But even at that time, it's still tax-free.
Got it. So a Roth is very beneficial to have to really, I guess, it's like a retirement account on steroids. Is that another way of saying it? Yeah.
It kind of is. The bad thing about a Roth, or not the bad thing about a Roth, but the difficult thing about a Roth is you can't make contributions to a Roth if you make a certain amount of money. And so your listeners will need to Google what that is. I think it might be like $160,000 a year for a single person and $220,000 or something like that for married people. So if you make more money than that, you can't contribute to a Roth. But after 2010, they made this thing called the backdoor. Well, it's called the backdoor Roth, where I can make a non-deductible contribution to my traditional, and then I can convert that to my Roth, and then I have to pay taxes on it. So for me personally, I'm actually right now going to convert a portion of my traditional account to a Roth. So how much ever money I decide to do that with, let's just say it's $10,000. I will have to add $10,000 to my taxable income this year and pay tax on it, but I'm putting it into my Roth, and now inside my Roth, that money can grow tax-free.
Makes sense. Yeah. Makes sense. I like it. Okay. So what are some of the biggest mistakes, something that we haven't covered, some of the biggest mistakes that you see syndicators make when raising capital from other folks that are using their retirement accounts?
That's a great question. I'm not sure that I see the mistakes on the syndicator side, but I see it on the other side where, well, maybe on the syndicator side, if they're not careful and if you get an investment from a retirement account, make sure you pay back the retirement account. I have seen situations where they get an investment from your retirement account, Juan, and then there's a profit on the investment and they write a check back to you instead of back to your IRA. And, that that's okay as long as you catch it right away and say, no, reissue this check and give it to the trust company.
Mm-hmm.
But if they don't catch that pretty quick, then it becomes a more and more difficult problem. So, from the syndicator's side of it, make sure that you issue the money back to, or the profit or whatever, back to exactly who made the investment.
Mm-hmm.
I think the other great thing we talked about was, if the syndicators would help their IRA investors by providing them some kind of a fair market value every year, that'd be awesome. And that would make our job much easier. On the other side of it is, the individual, on a syndication, there's not a lot of things that the individual can do wrong, because unless the person they're investing with is a disqualified party, their kids or their parents or something. But if it's a non-related individual that they're just investing with, there's not a lot that they can do wrong there. I can't think of anything off the top of my head. If we're talking about an individual that buys a house themselves with their IRA, then there are a lot of things they could do wrong, and they just need to be careful. The way I like to look at it is I like to tell them, like, the money that you're buying this house with is your friend's money. It's not yours. And so, if this is your best friend's money and he gave it and trusted you with it, you wouldn't take a little bit out for yourself, or you wouldn't necessarily go pay to have the toilet fixed yourself, or, you would try to keep it all in that same little bundle and make sure that what belongs in there went back in there, and what needed to be paid for out of there got paid for out of there. And that's the main thing that people do, is they just don't, they don't think, and they have they have a contractor that's calling them up saying, hey, in order for me to fix this roof, I need a check for $1,000 right now. And they write them a check out of their own personal account. And that screwed everything up right there. That just created a prohibited transaction. And it's impossible. I shouldn't say, I guess nothing's impossible, but it's very difficult to fix that kind of an error.
Gotcha. So you just got to be careful in what you're doing, and know the rules and what you can and cannot do before you start making those type of transactions, for sure. Okay, yeah. So good information. So it is time for our Nuggets of Wealth. These are questions that I ask every guest every week, and let's go ahead and get that started. So what is a good tool, source, or platform that you can recommend to others who have retirement accounts or self-directed IRAs? A good tool, source, or platform that they can use on a frequent basis. Okay.
Can I plug my own stuff, or do I have to find somebody to figure out?
Hey, no, go for it. Yeah. What is it?
Well, if they go to my YouTube channel, Sunwest IRA,
mm-hmm.
I have over 200 and probably close to 250 videos there now that they can look up. They're all short 3 to 5 minute videos. And it's just like this program. I can't give legal or tax advice, but it'll give them an understanding so that they can go to their tax person and ask the right question and know how to formulate the question. We get calls all the time from people who say, my CPA doesn't know anything about this, or we get calls from CPAs saying my client's wanting to buy a house in his IRA and I told him he can't do it, and so we have to educate both parties, and so that's a great place. If they go to my website, sunwesttrust.com, I've written a book that's fairly, kind of on layman's terms about how to use a self-directed IRA. They're welcome that, and that's free. So those are good resources for people to learn from.
Okay, so that was my next question. What book you're currently reading, but you can recommend this book. What was the book called?
Well, my book is called "If All You Have Is a Hammer," and the idea behind that was that self-directed IRA is just another tool that you can use in your investing. And so, the old saying, if all you have is a hammer, everything looks like a nail. But you have something, you have this, people have this resource that they didn't even know they could use to buy real estate or to buy something. They thought they could just buy CDs and stocks and bonds with it. So I'm trying to educate them that there are other things that you can do with that.
For sure. Okay. So what do you see your business and company in the next 5 years?
Well, that's a good question. We are, I think the majority of our business is in real estate, but cryptocurrencies and digital assets are becoming kind of a bigger thing now. I'm not sure that I believe in those yet, but a lot of people are looking into them, so that's a possibility. Hopefully, I've been in business 32 years this year. I'm only 58 years old, so I hopefully will be in business at least another 20 or 30 years. So,
okay, awesome. Yeah, that's good. At the end of your life, how do you want to be remembered?
oh, you know what? For me, family is the most important thing for me. So I've got 3 boys that work with me, and so if I'm just remembered as a good father, that kind of takes care of everything.
That's the way to do it. Okay. So where can Come Into Wealth Nation go to contact you and find out more about you and your companies?
Well, the best place is sunwesttrust.com. They can go there and they can click on the Contact Us tab and mention this podcast, and I will be happy to help and answer questions, whatever I can do.
Sounds like a plan. Okay. Well, then I have that here in the show notes for those of you that want to find out more about what he does or reach out to his team directly. So, Terry, it's been a pleasure. I really do appreciate your time, and I wish you continued success.
Thank you, Juan. I appreciate it, and same to you.
Yeah. Thank you so much.